on the clock. All right. Thank you, everybody, for joining our program today on private offerings in the microcap ecosystem preparation for trading. I'm Harvey Kesner. I'm a lawyer for 40 years, worked at Wall Street law firms as well as multiple practices after that, focusing on small cap, microcap space. And I'm going to do a little bit of education about state of the law today, and as well ask a couple of questions of my panelists, Mark Elenowitz and Mo Bhansali. Mark, you want to introduce yourself perhaps briefly, and then Mo?
Sure. My name is Mark Elenowitz. I am with Digital Offering. We're an investment banking firm that is, I'd like to say, a non-traditional firm. We kind of go against the grain of what traditional Wall Street bankers do. We're very active in the crowd finance space. We do a lot of underwritings. I'm going to be speaking at 12:15 later today discussing how that all works. But what we try to do is our offerings are diversified among anywhere from 3,000 to 10,000 investors. Most of our offerings are in the 10 to 25 million range, and they're straight common stock. And they all list on a national securities exchange. So we pioneered the ability to modernize Wall Street using modern techniques, but making it look, act, and feel like traditional underwritings and listing on stock exchanges without the toxicity and the problems and other things that we're all seeing in the microcap space.
Wrong time to get a phone call. Hi, my name is Mo Bhansali. I'm with EquiDeFi. Thank you so much, Mark. I'm with EquiDeFi. We're a software platform which facilitates private offerings, exempts from registration on our platform. We're not a broker-dealer. We like to call ourselves kind of the hub of a spoken hub model of private offerings, where we integrate with broker-dealers, issuers, investors, and various other parties that are part of these types of securities offerings. It's something that I've been very passionate about for the last few years. I'm one of the co-founders of the company, and we thought it was a great logical extension to the fragmented way in which private offerings were traditionally done or currently are being traditionally done. So we'll talk a little bit about some of the features of the platform which are important for today's modern world of private offerings.
Mo, you also work with DTC as well as a number of trade associations that facilitate the kinds of things you're talking about in terms of digitizing the marketplace.
That's absolutely right. You know, we work with DTC. The transfer agent side of this business works with DTC. DTC, as you may or may not be aware, is going to be creating an API for DWAC transactions. So there is modernization going on throughout various agencies in the industry. It's slow. There's the obvious gorilla in the room for that, but we work with those agencies to create some interoperability between our platform and and legacy platforms that are out there.
It makes me chuckle a little bit because I worked at the SEC in DC and Corp Fin from 82 to 86, and we were adopting rulemaking about dematerialization of certificates, and even today we still have stock certificates, and we still deal with paper flow and the difficulties that were faced 30 years ago are still very much the difficulties faced today. So I'd like to start with some thoughts and observations about the current state of the market, and then move to a little bit of the current regulatory environment. I think as of September last year, continuing today, we know that the chill that impacted capital formation for nearly all small private and public companies, venture, PE, still exists. And I think what we're going to really address here is rethinking some of the private placement markets and how investors and issuers can prepare for future trading. In terms of housekeeping and vocabulary, I think it's best to start there for this panel. The title of this conference is Microcaps, and I think it's important to understand that I think what most of the participants here and the panelists, as well as the lawyers, service providers, are dealing with are not what's traditionally known as microcaps. As you can see, the formal definition of microcaps is really not the world that many of us live in. And the market has been particularly unkind to what we know to be microcaps. So although microcaps are formally defined as market caps of 50 to 300 million, most of the universe that I live in and deal with and people have difficulties with are the NASDAQ and lower companies that sometimes have a $50 million to a $2 million market cap. And I think that's where most of the stress points are. So many of the things that we'll be talking about today are really focused upon the regulatory environment, the DTC issues, the practical realities of dealing with transfer agents, as well as the regulatory hostility to those smaller companies and how we kind of bide our time through and the energy we spend getting through most of those issues. I think the cost and time spent on offerings and the virtual shutdown of the small IPOs during the past couple of years has been really heartily felt by the smaller size companies that we're talking about. Then you tie in a strong dose of the regulatory assault on microcap issuers, and you really begin to understand the dilemma in the public markets that most of the people experiencing these one-on-ones looking for capital are facing. Sort of a repetitive need to hit the capital markets, hat in hand. The last panelist was talking about, the one before was talking about the damage done to important healthcare companies and drug development or startups that have really good, robust business propositions that just can't get past square one because they can't raise the capital necessary, or they're, instead of focusing on their business, they're always got their CEO involved in raising capital. So I'll ask Mark, is this something that you're seeing as well, and is the friction involved in transitioning out of the sort of paper-based traditional method of raising capital somehow in the focus of what digital offering is doing?
Yeah, I mean, so the market has certainly been a challenging time. We all experienced it over the last year and a half, 2 years. I mean, Harvey, you just said it perfectly. All these companies are looking for capital, and unfortunately, a lot of the capital that's available is quite toxic. And companies are left with very little choice because they need to be able to take this capital in order to continue their businesses, but it's a damned if you do, damned if you don't, because ultimately these stocks are suffering because of structure. And what we're finding is there are so many new techniques that are available because of recent legislation, that occurred back in 2015, which was something called the Jobs Act. And it opened the ability to now reach a larger audience because pretty much everybody here knows everybody. We're all friends. We've all been working together over the last 20, 30 years on the street. But there's the rest of the world that wants opportunities to be able to invest in these types of exciting growth opportunities. And they don't get the ability to do so because the old school days of having a stockbroker call up Mr. Jones during dinner and annoy him and then convince him to buy stock is really gone because everybody can go to E-Trade and Fidelity and buy stocks for free with no commissions. So we're trying to look at new techniques in order to modernize investment banking and basically keep up with a world that communicates in real time, real fast, using social media and other types of tools. Now with Jobs Act, we can do that. And Jobs Act isn't just limited to what I'll be talking about later, which is Reg A+, but it's also being able to utilize exemptions under Title II, which is 506C, which is the general solicitation of private placements. And people don't really understand what that means, but in theory, you could put an ad in Times Square, or you could put an ad in the Wall Street Journal and say, I've got this great new widget, and you should invest. And now you can go out and do that legally. But there are constraints on how you're able to accept that capital, and that's where working with EquiDeFi and working with Harvey, there are modern techniques of using technology that enables the ability for investors to get access to information, access to investment documents where you don't have to FedEx them anymore, and being able to then contribute the investment by using cash, an ACH, or actually using credit cards. So I think we're seeing a new modern way of capital formation, and Wall Street's been slow to adopt it. We had digital offering, we embraced it, and we're actually doing quite well with it for our clients.
Mark, you make me laugh. You said that many of the people in this room are friends. I think the word is frenemies.
Yeah.
I think that's the right, we're friends, but there's a little friction amongst the friends because we're all competing as service providers.
Exactly.
Mo, you want to talk a little bit about the frictionless approach that EquiDeFi has adopted towards?
Absolutely. And Mark's made a great series of points in summarizing the modernization of these types of workflows for investors, especially a new subset of investors, which is growing, which is that accredited, certified accredited investors under 506C. What we've seen from the 70s, where there was a very, very small population of those investors, Harvey will talk about, that universe of investors is greater, and it's a rich market to tap into. So how does EquiDeFi help these types of investors? Well, traditionally speaking, conducting private offerings, exempt from registration, required a tremendous amount of paper, various different parties involved, lawyers, et cetera, to be able to get deal documents out, and the traditional method of just signing these documents and wiring and getting your KYC, AML checks done, et cetera. What we've done is we've created a workflow that essentially digitizes and modernizes all of these different, let's say, modules or steps. And these will always be required because they're required under the regulation. But how can we create a better mousetrap? How can we do this to reduce the amount of friction for investors, thereby creating an exciting conversion rate? And I think one of the biggest points of friction has always been the KYC and accreditation side of this. There are lots of investors, the potential investors that are out there, that probably don't even know that they're accredited. I would probably think the supermajority of them, that they would qualify for the types of offerings that Mark is talking about that could be marketed to them. So let's say now that they do understand that and they are qualified, let's say, purchasers here for those types of offerings. Once they get into what would have been the traditional funnel, it's very unexciting and quite intimidating. So what we've done is we've modernized that process by creating various steps, which are user-friendly, and most important being the KYC side of things. And it makes brokers' jobs easier to be able to assess this information and pass these investors through in a compliant and legal manner. Issuers happy, brokers happy, investors happy.
Now, Mo and I have talked, routinely about the founding of EquiDeFi being about getting rid of that pile of paper in the back of your office when you go to put your securities into a brokerage account. Where's the document? Where's the PDF? Where's the signed agreement? Where's the bank confirmation? All the things that the compliance people at the brokers live about have historically been dealt with very haphazardly. Go find an email from 3 years ago, and EquiDeFi is really solving a lot of those problems through electronic signatures. And I'll say, coming from the legal community, to this day, many lawyers are still extremely uncomfortable with electronic digital signatures and using DocuSign. I just had a conversation yesterday with a major broker in New York. And they said, our brokers, basically are still using faxes. Get them a salami sandwich and a fax, and they're happy. They're really not up to even using DocuSign yet in many of the communities in which private placements are sort of the foundation of capital raising. So I'm going to switch gears a little bit now. Slide 3. And I think any conversation about capital formation, in this world where there's a dearth of IPOs in the public markets, private equity, VCs are all seized up, as we all know from reading the paper every single day. Private placements and the world of accredited investors and exempt offerings have really found a new place and are possibly, the only robust market that is still funding startups. And I think we all know that Regulation D, which was adopted in 1982, came out with this whole concept of accredited investors, and only in 2020 was that expanded somewhat. So let's review. Accredited investors are considered to have sophistication because they meet specific regulatory requirements, criteria. And Rule 506, as Mark mentioned, 506C is a special flavor of Rule 506, allows unlimited dollar amounts to be offered and sold to these accredited investors. So generally speaking, directors, officers, general partners of an issuer, and individuals having a net worth exceeding $1 million or net income in excess of $200,000 or $300,000 with your spouse in each of the two most recent fiscal years, I mean, everybody probably knows this from memory in this room, are the cornerstone of this investor community. And after 10 years, in 2020, the SEC expanded this to include people with certain degrees, family offices in excess of $5 million of assets. And this is my favorite, as a tribute to wokeness in the securities industry, expanded the definition of spouse to include a spousal equivalent. So now your spousal equivalent can count towards your net worth. Mo, historically, accreditation testing for accredited investors has been a paper-based honor system through investor self-reporting via questionnaires. And with growing needs for regulatory compliance and good audit trails, especially for 506C, where bus ads, not that I advocate bus ads for selling securities, are lawful, what is it that EquiDeFi is doing to create a better audit trail and create sort of frictionless, relieve the burden of sending PDFs and faxes and looking at emails for these important documents?
Yeah, that's a great question, Harvey. So, we on platform, so if you go on the platform and if you're participating as an investor, you'll be able to digitally sign these documents, of course, through the integrations that we have, whether it's DocuSign or going to be Dropbox Sign. And what we've also done is to be able to facilitate this process is do real-time KYC, KYB checks. Everybody knows about KYC, but not many people understand the concept of KYB and how difficult or tricky it can be to be able to have UBOs, beneficial owners, essentially also being checked, for a lot of these types of offerings where you have, an LLC or you have a GP with LPs underneath it. All of that stuff needs to be checked. And through these on-platform types of checks, Harvey, we can integrate with databases around the world, and Mark is aware of this as well, where we can do the requisite OFAC sanction checks, PEP checks, adverse media checks, all that sort of stuff. And that's all of that information has a digital footprint. So we capture the IP addresses, as you're aware of anybody coming in to the platform. We capture their steps, all that sort of stuff. So from a compliance standpoint, this sort of digital footprinting and watermarking is essential for any type of regulatory search that may or may not occur afterwards. We have those files and they're encrypted in the cloud. So, all of that stuff is currently being done. So the days of self-reporting, your accreditation might just still be reserved to the 506B type flavored offerings, but in the 506C offering, it's a little bit more belt and suspenders. And we've been able to digitally evolve to be able to do that.
I think of it as a terrific firewall for the compliance people at the broker-dealers and also an audit trail and someone else to blame. But in reality, it's you can't have enough confirmation because historically, as everyone knows, an accredited investor questionnaire asks the same stupid question. Someone signs it, sends it in. There's no confirmation of identification, no driver's license or passports or background checks, nothing to prove that even the person that signed it is the right person. And it's the bare minimum, minimally kind of acceptable practice just so you can open a drawer someday and say, oh, they were accredited. The issue also comes up later when someone is depositing shares. Does the SEC mean that you have to be accredited then, accredited later, when there's multiple closings, when there's an exchange offer? At various points in the life cycle, from the issuance of securities all the way to getting them into your brokerage account to sell, which is everyone's ultimate goal. What happens if someone loses their accredited status, and where's the check that confirms that? And people's situations change, and and they may not be accredited when they go on a deposit when they were initially, or vice versa. So, Mark, in your compliance department, what are some of the risks that you see as a broker-dealer with regulatory spot checks and audits, and how do you handle this, and what problems have you seen, or what successes have you seen?
Sure. So one thing I think it's important maybe for the audience to know, because we're talking about accreditation verification and how that works. Just to kind of backtrack for a moment, when you're doing a Reg D 506 B or C, there's different types of what a private placement is. A B means that it's a confidentially marketed deal to somebody that you have a pre-existing relationship with. So either the issuer or the broker-dealer has done business with this particular investor, and the investor can self-certify their accreditation, meaning they check the boxes like what we like to say. When Jobs Act came out and 506C came around, which allowed that general solicitation, like I said, the ability to go ahead and post it on Instagram or on Wall Street Journal or even in Times Square, everyone can see it, but you have to be accredited to buy it. And it's no longer check the box. You actually have to prove accreditation. And that accreditation can be proved by three ways. You can either send in a copy of your tax return, you can send in a copy of your W-2, or what we developed at our firm is we use the methodology around a pro letter where only 3 people can certify a pro letter, which would be an attorney, an accounting firm, or a broker-dealer. Now that sounds great, but the reality is when you're soliciting people that you don't have relationships with and you're asking them to send your tax return over the internet, I mean, we just heard the whole thing on the panel before about safety protocols and cybersecurity. The beauty of working with a platform that has secure interface like working with Mo and his firm is that we as the broker-dealer have confidence that that information is going to be safeguarded under what's called Reg SP, which is safeguarding that protection. And that information is then put behind the broker-dealer on our firewall, so we know that, one, the audit trail is in place, that we actually know who this person is. And then we take a step further where and this is another important aspect of it, technology does not 100% solve the process. It makes it a lot easier, but you still have to have human intervention. We still need to verify that information. We need to then verify the person that's writing the pro letter. We've had people who have made fraudulent pro letters where they make up the name of somebody. The broker-dealer's responsibility is not to rely on any one information, but to do independent verifications. So we go beyond, we look up the CPA number, we look to see if they're licensed. We actually had a legitimate client that we're working with EquiDeFi on right now, where the guy's certification as a CPA expired on December 31st, 2023. He just hadn't gotten around to sending in his renewal. We can't accept that because he's not a valid CPA. So those are the type of things that you need to look at from a compliance standpoint. And the other important aspect of 506C is you don't need a broker-dealer to do this. Issuers can raise their own money doing it, but the problem that you have is if you violate the statute, the entire offering could be at risk. So there's a lot of companies that go out and they think they're going to be doing this 506C. They're really excited about it, and they find it so hard to get people to send in their tax returns, so hard to send in this information, and they say, the hell with this, and then they just start going back to 506B without closing it. You just blew your entire offering. So it's important to have proper legal guidance, proper platforms, and selfishly, I recommend having a broker-dealer who actually knows how to do this.
Thank you, Mark. I was actually going to mention that if you even have one unaccredited investor, your disclosure standards under the law rise to the level of what's in Regulation SK as if you were filing an S1. And you can have one unaccredited investor can blow up your whole offering in terms of the document and disclosure packages being given to investors. So that was a crucial point. I really appreciate it that you mentioned that. And I can assure you that if the regulators came in and did your spot check and happened to open that drawer and happened to pull that accountant and happened to say that, hey, that accountant's CPA license expired before the pro letter, they will be unforgiving. They're not going to care. Then you're going to be dinged with that flaw. So there's no amount of checking that is enough. You know, every resource that you have should be used in order to confirm great exemptions. Why do I say that? You know, with the dearth of IPOs, VC, private equity funding, the pool of candidates for getting check writers comes from the accredited investor universe. Well, I did a little research on this. These are the numbers. Today, because the credit investor standard is $200,000 of income or $1 million net worth, you know, many people with a house just own a house, you have $1 million. Oh, you're not allowed to use your primary residence, sorry. 18% of all households today, 18% or 24 million households are accredited investors. And I can assure you they're not all investing, but they're all capable of investing in these private placements. In 2022, the private placement market was reported to be $4.5 trillion. That's larger than the IPO market. I mean, even with some of the, the mega IPOs of the era. So I think, if you're talking about a self-offered transaction where you're looking for accredited investors, where you want to do a general solicitation or not, you could sit, normal brokerage, you go to a broker to raise money in private placement, it's 10% plus warrant coverage, right? I mean, in here you can do a self-offered private placement, and you could satisfy all the regulatory requirements, and issuers can really do it themselves, or with the mentoring and slight oversight of a digital offering that brings the regulatory checks to the process. And I see we're almost out of time, so I think we'll just entertain any questions if there are any. No questions, great.
I have actually a quick question for Mark and for everybody else's edification as well. So Mark was mentioning that his firm Digital Offering has this methodology of using pro letters as an acceptable form of accreditation certification. I actually just had a conversation, I found this very interesting. I had a conversation with a major ATS just a couple of days ago. I think, Harvey, you were on that call as well, where the ATS is a broker-dealer.
ATS is an alternative trading system where people can sell their secondary shares in an aftermarket that's not a NASDAQ.
So that ATS was actually accepting pings to an investor's bank accounts so that it would meet the asset threshold, and based on that asset threshold ping, so if they had over $1 million in the bank account, the ATS would certify that they would be accredited. Is that something that you would be comfortable with, Mark, as a broker-dealer?
No, no, absolutely not, because you might have $1 million in the bank and you might have $50 million in debt, so you're not accredited. It's $1 million in assets, so you need to rely on more than just one bank statement. You need to be able to verify, and that's where a broker-dealer should. And a broker-dealer's responsibility is not only KYC, but it's CIP, it's suitability, understanding the objectives of that investor, because there's a slip and fall guy that might have been a plumber who just got a $10 million settlement. He is certainly not suitable to be buying speculative investments. So it goes beyond just looking at an API integration to a bank account.
Correct, and then alternatively, somebody can just wire in X amount of money on one day, and they just for the purpose of getting this so-called certification, and then just wire that money out. So that does not speak to investor suitability, as you said, Mark. Any other questions?
Last chance, no questions? Going once, going twice? All right, thank you, everybody.
Awesome. Thank you, guys.